First up, we are going to be talking about constructing a mutual fund portfolio, and if any of our viewers have not done that, then I think now is the time they should straight away get to it, especially if you're young, especially if a long time horizon. And SIP is always a great way to kickstart your wealth creation journey process. So to talk about that and more, we have with us today Harshvardhan Roongta of Roongta Securities. Harsh, thank you so much for joining us on The Money Show. You know, I suppose the very first question that people ask us is that, yes, it's right, we should start off a mutual fund. We should sort of invest in the equity markets, take part in India's growth story, and you can do this by investing in a mutual fund. But the fact is, there are more than 40 AMCs or mutual fund houses, SBI, HSBC, Kotak, Axis, etc., etc. And within that, there are several categories as well. Within equity, there are different categories. You have debt, and then you have thematic as well. So if I am just kickstarting my mutual fund investment journey, where should I start off then? I mean, how do I know that this particular AMC or this particular category is the right choice for me?
So, well, Movina, you're right when you said that we've been advocating investing in mutual funds as a tool for wealth creation, because there are professional fund managers who take care of your money. But the biggest dilemma in front of an investor is that, there are 40 fund houses, as you rightly said, each fund house offering more than 10 to 15 kind of equity schemes and even more in the debt. So the question arises, how do we go about, demystifying this entire process? So I would say follow a 3 or 4 step process. It's not that difficult. Of course, yes, you will have to put in some efforts, and always if you have somebody to handhold you who's an expert in this field, it will work better for you. But the process is simple. So the first step should be that which is the AMC out of these 40 AMCs. So you could handpick about say 6 or 7 AMCs, the asset management companies, based on their parentage. What are the other things that this company does? How long have they been in money management business? I mean, has it been just recently they ventured into it, or they've been here for like 20-30 years from now? Then what is the pedigree? What is the research team? How do they go about with the investment philosophy? So first step would be, out of these 40 mutual funds, you'll have to shortlist the companies that you are comfortable handing your money over to. So once you've got that list down to say about 5, 6, 7 or 8 for that matter, then the second step would be, you decide how do you want to split your money. So if you're going to allocate say X portion into equities and a Y portion into debt, then within the equity portfolio itself, how do you further divide it? How much of this money will go into large caps, mid caps, multi caps, thematic, sector? You will have to first ascertain that part. After you've ascertained and probably you say I want a 30 or 40% going into large caps, then what do? Which of these shortlisted AMCs, the 7 or 8 AMCs that you shortlisted, which of these 7 or 8 AMCs offer the best large cap fund? Because you've already identified that there is a portion of your money has to go into large cap. Now you've also shortlisted a couple of AMCs whom you want to entrust your money with. So which of these 7 or 8 mutual funds offer a good large cap fund? So you may pick 1 or 2 as your fund is, whatever your amount that you want to invest, what is your preference, and then invest into those large caps, mid caps, multi caps accordingly. So this becomes a step-by-step process to eliminate what you don't want and come to shortlisting what you want. Now with regards to performance, I'd only like to make one reference here. Many a times we see a layman investor looking at the past performance of say 1 year or 3 years to evaluate which is the top rated fund in that category, and then we select that. However, that could be a very misleading data point to start with, because if a fund house or a particular scheme has done very well only in the last 1 year, but if you look at the 10 or 15 years consistent performance, I mean what I mean by consistent is that they need to be good marathon runners. We don't want a 100-meter sprinter here, because your goals are also for long term. So evaluate a fund house and the scheme basis on the long-term performance and the consistency of performance. So once you've done that, I think the method of elimination will help when you have too many schemes on offer to you.
Okay. Now, very often the other question then that's asked is that, equity funds, equities in general, of course, have its fair amount of volatility. Now, we may have mutual funds that do tend to fend a little bit of the volatility, but the fact is that every mutual fund at some point or the other will perhaps erode some capital. Like for example, in the last 2 years, it was the small cap funds that did see, a fair amount of pressure come by. So what would you recommend they do in such a situation? I mean, what do you do when, your mutual fund is sitting on a loss?
Yeah, so Mubina, this is a very relative term. So first is what I have invested. Suppose I have invested a lakh of rupees and that is showing the fund value at that point in time is now showing at about 90,000 rupees. So I have invested 1 lakh and my fund value is 90,000. Should I blame the fund house for this is the first question. So what you need to see, if you invest in an equity fund, now your investments are down by 10%. The places, the large cap or a mid cap or a multi cap or a general market in perspective has fallen by about say 15%. So if the market has fallen 15%, you are invested in the same market and your fund manager has managed to fall only 10%, then I think it's outperformance. In fact, you're doing very well. Your fund is doing very well and your money is into safe hands. So you will have to evaluate not only basis on what you have invested to what the market value is today, but what the underlying market in general has been. So this is the first parameter when you check the performance with a benchmark. So benchmark is the index against which your fund is comparing itself. So from a layman, the first level would be, of course, check with the benchmark. So if you've fallen less than the benchmark, then you're doing very well. The second level of comparison would be, okay, my fund has fallen by 10%, market has fallen by 15%. But had I given this money to other schemes, not this particular scheme, but other scheme, how much have they fallen? So if they have fallen also 10% or say 11 or somebody has fallen only 3%, then there is a point of comparison. If there's somebody else who could fall only 3% against a 10% which you have fallen and a 15% when the market has fallen, then the person who's fallen by 3% has outperformed. So that is the time that you will again start comparing whether I should remain in this scheme or not, because it has beaten its benchmark but not the peer average. So these are the parameters that you try and evaluate. Of course, if you've invested a lakh of rupees and it becomes 90,000, you're not going to like it. But you must understand that the money is eventually getting invested in the market itself. If the markets fall, your fund manager cannot give you positive returns. I mean, that is too much to expect out of him.
Fair enough. You know what, Harsh, we've already got our phone lines ringing. So I was going to ask you one more question, but I suppose for the benefit of our viewers, let's kickstart our Ask the Money Show segment. We have our very first caller, Mr. IP Singh, joining us from Mohali. Mr. Singh, hi, good evening. Thank you for calling in. What's your question, sir?
Yeah, good evening. Good evening, Adam. Good evening, Mr. Harsh. My question is it the right time to invest in ultra short or short duration funds? Because even the good fund managers, they could not see the telecom judgment that was coming and there was fall in NAVs.
True, yeah.
And is investing in debt funds, such type of debt funds, is SIP the good way or a lump sum bond is to be deposited to park my idle money?
It's a topic that we just discussed about 2 days ago. You know, this entire Vodafone issue is something that really did hurt a lot of, debt mutual fund NAVs. But again, Harsh, this is not the first time that we've seen something like this happen, right? We know it happened in IL&FS, we know it happened in DHFL as well. And unfortunately, it will not be the last time either, right? So anyway, Harsh, what would you recommend? And I would like to throw in one more factor over here that would move the needle for ultra short and short duration funds, and that's inflation, because it's really making a roaring comeback, and we may have some measures as well that will be announced by FM Sitaraman, on Budget 2020. So in light of all of that, what do you think of this category of funds?
So well, Mubina and Mr. Singh, let me just answer this with the general attitude as to why you invest into debt schemes. So when you're looking for growth, when you're looking to get double-digit returns, or when you're looking for high returns, you would go invest into growth assets such as equity. Debt as an asset class is meant for preservation of capital, wherein you've already accumulated that capital. Now you want to preserve that capital and generate a return on it, which could be probably better than what a bank gives you, or a more tax efficient way of investing. So that is your approach to investing into debt. Now what happens is when you invest into debt, and that scheme underlying investments have been into Vodafone Idea, have been into IL&FS, DHFL, SL Group, or any such companies which have probably defaulted or going to default or have been downgraded, this starts affecting the NAV. So has been the case currently which you're talking about, wherein a short-term fund is also eroded by about a 4.5 to 5%. So the idea would be, when you are picking to invest, look to invest into schemes which have got only AAA rated papers, which has got a well diversified portfolio, the investment into any one company does not exceed 5%. So when you take these kind of caution measures and when you invest, undoubtedly a AAA rated overnight could be going into default. That's a different issue altogether, but at least you've done your bit. Now what happens is when investors look for higher returns and invest into companies which have, again, relating it back to the performance that we spoke about. So there was one of the schemes which was giving very high returns in the short term category, and there was another scheme which had a AAA rated paper and it was naturally giving a lesser return. So when you picked up a scheme purely based on return, you had picked up that particular scheme which was having a AA and even minus rated papers into their short term funds. So naturally they're giving better returns. So you picked and invested looking at only purely the returns. So that is where we were talking about initially, to say that look at several other factors, not just the returns. So my suggestion to you, Mr. Singh, is most certainly do not hesitate to invest into debt mutual funds. Just make sure the schemes that you pick are investing only into AAA rated funds. So, so at least you're secure from that point, and going in, keeping in mind the capital preservation objective, you are preserving your capital, getting slightly lesser return. So that's fine. So one of the schemes that invests into this AAA rated papers only is the IDFC short term bond fund. So that has only a AAA rated portfolio. So you'll be comfortable in that perspective. To answer your second question, which was to invest lump sum or through SIP, well, equities are volatile in nature, and to beat that volatility or to ride that volatility, we suggest SIPs. When it comes to investing into debt, it's not supposed to be as volatile as it is happening these days. So do not, if you have the lump sum, you're supposed to start getting returns on that from day one itself. So without hesitation, you should invest as a lump sum into debt funds. I hope I've answered both your queries.
All right. Well, Mr. Singh, I hope that's helped you understand the concept of these two categories of funds. Okay, we have another caller, Jitendra Kumar, joining us from Bihar. Jitendra ji, thank you so much phone करने के लिए. आपका क्या प्रश्न है?
मेरा प्रश्न है, वोडाफोन आइडिया इशू के कारण फ्रैंकलिन अल्ट्रा शॉर्ट टर्म बॉन्ड फंड के एनएवी में गिरावट आ गई जी. अगर उस इशू का समाधान हो जाता है जी, तो एनएवी के गिरने वाले जो इन्वेस्टर हैं, हाँ, और एनएवी के गिरने के पहले वाले जो इन्वेस्टर हैं जी, और एनएवी के गिरने के बाद जो इन्वेस्ट करते हैं, उसके रिटर्न पर क्या असर पड़ेगा?
ओके, अंडरस्टूड. वेल, हाँ, फ्रैंकलिन ने क्या किया है कि उन्होंने 100% राइट ऑफ कर दिया है. तो अगर कुछ पॉजिटिव न्यूज़ आता भी है तो आपका एनएवी ऊपर ही जाएगा. उन्होंने ऑलरेडी वर्स्ट केस सिनेरियो ले लिया है. सो इट्स अ वैलिड क्वेश्चन, एंड या हर्ष, अ लॉट ऑफ फ्रैंकलिन फंड होल्डर्स मे बी हैविंग दिस क्वेश्चन. सो इफ यू कुड रिस्पॉन्ड इन हिंदी एंड हेल्प आउट जितेंद्र जी.
वेल जितेंद्र जी, मुबीना जी ने जो आपसे कहा वो सही है कि फ्रैंकलिन ने क्या किया है. फ्रैंकलिन ने एक प्रीएम्प्टिव मूव मेजर लिया है, जिसमें उन्होंने देखा कि वोडाफोन आइडिया का जो AGR के जो पेमेंट्स करने हैं, शायद उसकी वजह से उनको उनके डेट सर्विसिंग में प्रॉब्लम आ सकती है और आगे जाते हुए वो डिफ़ॉल्ट कैटेगरी में जा सकता है. इसका अनुमान लगाते हुए उन्होंने अपनी जो उनकी वैल्यूएशन थी, वो मार्केटेबिलिटी कितनी है उस बेसिस पे उन्होंने बोला कि अब ये मार्केटेबिलिटी नहीं है, इसकी वैल्यू ज़ीरो है करके उन्होंने पहले ही उसे ज़ीरो वैल्यू ले लिया. तो उसकी एनएवी पे असर आया था. करीबन 4 से 6% के आसपास उनकी एनएवी गिरी थी, क्योंकि उनका एक्सपोजर उतना था. अब ऐसा है कि अगर आज के टाइम में जो पहले से निवेशक थे इसमें, उनकी एनएवी में रिडक्शन हुआ है, जिसकी वजह से उनको आज की तारीख में लॉस हो रहा है. अभी फ्रेश इन्वेस्टमेंट्स जो हैं वो उन्होंने रिस्ट्रिक्ट कर रखा है कि कोई नए निवेशक अगर अभी स्कीम में डालना चाहते हैं तो 2 लाख रुपए से ज़्यादा नहीं कर सकते, ऐसी उन्होंने रिस्ट्रिक्शंस दी हैं. तो कोई अगर ऐसा इन्वेस्टर है, ये समझता है कि मुझे अब ये डिफ़ॉल्ट तो होने वाला है नहीं, राइट डाउन हो चुका है, मुझे सस्ते में मिल रहा है, कल जाके ये टर्न अराउंड होगा और मेरी एनएवी में फिर से बढ़ोतरी मिलेगी, तो अगर वो अभी आके निवेश करते हैं और सच में अगर उनका वैल्यूएशन बढ़ जाता है तो एनएवी में जो बढ़त होगी वो पुराने इन्वेस्टर को भी मिलेगा और नए को भी मिलेगा, अगर पुराने ने एग्जिट अभी तक नहीं किया है तो. सो अगर आपका इन्वेस्टमेंट अल्ट्रा शॉर्ट टर्म या फ्रैंकलिन शॉर्ट टर्म इनकम फंड में है, जिनमें ये वैल्यूएशन का असर हुआ है और आप ये विश्वास रखते हैं कि ये टर्न अराउंड हो जाएगा, तो आप अभी इसमें से मत निकलिए. अगर आपको लगता है कि ये टर्न अराउंड नहीं होगा, आज जो वैल्यूएशन है वो मैं निकल जाऊं, तो आपके लास्ट 1 ईयर का अगर हम इफेक्ट देखें 4 या 6% से अगर एनएवी घटी है तो आपके 1 साल का रिटर्न चला गया, लेकिन प्रिंसिपल मोटा मोटी उतना ही रहा है. सो म्यूचुअल फंड में इन्वेस्ट करने का फायदा ये होता है कि आपका एक्सपोजर जो होता है वो मल्टीपल कंपनीज में होता है। एक अगर डिफॉल्ट भी होता है तो इस पर्टिकुलर केस में आपका 1 साल का रिटर्न गया है, प्रिंसिपल सेफ है। सो आप निकल सकते हैं, नहीं है विश्वास रखते हैं तो बने रहें। पुराने और नए कस्टमर, इन्वेस्टर्स सभी को उसका फायदा मिलेगा अगर इसकी एनएवी आगे जाते हुए बढ़ती है तो।
Okay, I hope Jitendra ji, this has helped you out with your question. Okay, we have Subhash joining us now on the phone line from Bengaluru. Hi Subhash, good evening. What's your query?
Hello.
Yes, Subhash, good evening. What's your question?
Yes. Good evening. Yes, mine is a related question to what you have been answering for
Yes.
the last couple of minutes.
Ji.
See, we go to the mutual fund because of the diversification.
Yes.
Okay, you invest over a spectrum of opportunities. In our case, in Franklin Templeton case, we lost 4.5 to 5.5% in debt mutual funds just in one day.
True.
Doesn't that amount to a exposure of 5% in a particular instrument or particular vehicle?
Well, he's got a very valid question because, we always speak of diversification, and that's the reason why you invest in a mutual fund, right? So that even if one takes a knock, maybe the others can cushion this fall. But the fact of the matter is that Franklin did have that 5% NAV. So Harsh, any comments on that fact?
So Mubina, this in the hindsight saying that they were invested 5% or 6% for that matter in a particular company. So if you're managing an X amount of money, you will divide it into say 5-10% into one company into 20 companies. You cannot have 1% into 100 companies. So if you are managing X amount of money and you say 1% maximum holding and I will have 100 companies, only then will you have a exposure of only 1% across. So, you will have to have a basket where the exposure will be 4-5%, is I think very normal. And on the other side, if there was something very good to happen, now suppose there's a turnaround and there's a 5% exposure into this, you'll also get a 5% jump in the NAV. So answering the query, I understand the apprehension why there was a 5 or 6% exposure only in one company. But from a practical standpoint, a fund manager cannot have only 1% exposure in a company. He'll have 100, 200 companies to invest into. That doesn't really make sense. So while I understand the pain Mr. Subhash is going through, but the good side is that the exposure is only 5%. And that's the beauty of investing into any mutual fund. They have a diversified portfolio. Your losses are restricted only to that exposure that you have, which in this case is 5%. And that ineffectively translates only the returns being eroded and not the capital. Though I wish even this 5% erosion would not have happened, would have been much better. But I think let's look at the positive side of this entire structure of a mutual fund wherein your losses get restricted only to a portion and not the entire amount.
Think about it like this. What if you had bought a share of Vodafone Idea at 50 rupees, 70 rupees, even 35 rupees. Right now the share price is only worth 5 or 6 rupees, right? I mean, there has been significant capital erosion over there. All right. I hope that's answered your query, Subhash. Let's move on and take on board our next query. Muralidhar is joining us on the phone line from Chennai. Muralidhar, thank you for calling in. What's your query?
Ma'am, I want to keep in my portfolio up to 5% for. So how to choose?
Sorry, Muralidhar, could you repeat that actually, because we lost you over there in a bit.
No, actually,
yes.
I want to keep 5% of my portfolio for gold investments.
Okay, all right.
How do I select gold investments through mutual funds? That is my question.
Okay, fair question. All right. Harsh, 5% I think is a decent amount to put in gold. How do you recommend he go about, using this 5% to expose himself to gold?
Allocation of 5% into gold is absolutely fair. In fact, we even encourage investors to go up to 10% and that's fine. And in this 10%, we are not including the jewelry or any other form of gold that you have for self-consumption. So 5% purely from an investment perspective in gold is fine. Now, the most efficient way of investing into gold currently is the sovereign gold bonds. So I would suggest if given a choice and if you can go through that route, please take the sovereign gold bonds, because you also earn a 2.5% interest besides the appreciation in the or the changes in the gold prices. So that is one of the options you can choose. However, in case you want to go through a mutual fund route only, then of course gold funds are being offered by mutual funds, and you can invest into them. So it's just like a regular investment that you do in mutual funds. It could be through an SIP, it could be through lump sum, it could go directly debited from your bank account. Whatever you do exactly for your regular mutual fund schemes, you will do for gold investments, but it will be a gold fund and not an equity or a debt scheme. So I don't think that should be a problem. The third alternative, in case he wishes to exercise, is that he buys gold ETF off the exchange. Just like you buy shares through a broker on BSE or NSE, you could buy gold ETFs. So just ranking it, I mean, gold, sovereign gold bonds to be the most efficient. If not, then you can take the mutual fund route and you could go through a gold ETF or gold funds.
Okay, all right. I hope that's helped you with your question. Let's take on board our next query. Sanket from Mumbai joining us on the phone line. Hi, Sanket. What would you like to ask Harsh today?
Hi, good evening, guys, and thank you for taking my call.
You're most welcome.
I have a couple of questions. Both are related to long term.
Okay.
My first question is, does it make sense to invest in thematic funds like consumer or MNC funds for children's education if you have a 15 to 20 year time frame? And second part of the question is for retirement, which is about 25 odd years long, does it make sense to invest primarily into large cap, or have a mix of large, mid and small? And if any funds that you recommend for any of these, that would be wonderful.
So I would assume, Sanket, that you do not have any mutual funds currently. Is that right?
No, I do have a few of them. I like three or four of them.
Three, four. Okay.
Yeah, but each of them is tied to a specific goal, but nothing for retirement per se or for children's education.
Okay, fair enough. In fact, yeah, I think, Harsh, one of the topics we wanted to discuss is tying up a mutual fund with specific goals. Okay, I understand his interest towards thematic funds because, some of the best decadal performers have actually been thematic funds, like maybe an FMCG fund. Again, an oil and gas may have done well in the last 2 or 3 years, right? So I suppose it does pique one's interest. So that's one question. That's for his kids' education. And the second is retirement, which is 25 years. So what sort of a mix would you recommend he have for retirement, and of course your view on the thematic funds?
Sanket, if you're looking at thematic funds or a sector fund or anything like a, or an MNC fund for that matter, you must understand that a theme which works in a particular time may not be relevant all throughout the next 10 or 15 years. So at one time, textile companies did extremely well. At one time, you would see IT companies did very well. At one point, you would see the consumption theory now, because of larger growing population, earning population, the young population of India, you will see consumptions going up. So the point is, when you look at thematic, again, they are very seasonal. They could be one patch, a purple patch of say X number of years where they do well. Now the question is, if you're investing in a diversified mutual fund, they will also have these themes invested into. Just that they will not have only these themes invested into. So if you are a layman investor trying to just get the best out of the equity market as a whole, why would you restrict yourself, or why would you burden yourself with tracking these themes yourself? Because you will also need to know when to get out of it. If that is your full-time job, then you can go ahead doing it. But if it's not, if investing is your passive activity, it's not something that you do full-time from morning to night, then don't try and engage yourself into it. I would suggest go for a diversified fund, because that will also try and capture all these themes. The fund manager is aware what is working in the economy and what is likely to be the the next push in the economy and which segments are going to do well. So they will try and have allocations from those sectors, those themes in their portfolio, and a diversified portfolio as well. So first suggestion, of course, try and go for a diversified fund. MNC as a concept is reasonably good because it's a diversified multi-cap fund. Just the underlying objective of selecting the companies is that they should be a multinational company. So either it could be Indian multinational or a foreign multinational, which means that some Indian company has has presence globally, or a global company having presence in India. So that could be one of the filtration points, but not certainly the thematic in terms of the consumption stories and etc. The second query of yours was towards retirement. Should you only build a portfolio of large caps, or you should build a mixed portfolio? So you should have a mixed portfolio. Now within that mix of portfolio, the allocations could depend on where your comfort levels lie. So large caps could form about 50, 60 or 70% of your portfolio, because that is where your comforts lie. But there are very good mid-cap companies also which have a potential to become large cap for tomorrow. So why not have some bit of exposure into this? Now, you could have a 20 or a 30% exposure into mid-caps. Now, even one step further, if you don't know how to divide this, then there are multi-caps as an option. You can give the fund manager the liberty to pick and allocate as much as they like within that particular, within large, mid or small cap. So answering your query, it's not entirely wrong to have only a large cap portfolio for retirement. It's not wrong. Just that some very good mid caps who have a potential to become large caps tomorrow, why not have it in your portfolio, especially when you have a 20 to 25 year time horizon? If you don't know how much to allocate yourself, put in a multi cap. If you know how much to break up, then you can choose a dedicated large and a mid cap accordingly.
Okay, I hope this has helped you out with your question, Sangeet, and we wish you good luck with your investment journey. Okay, I think we have time for one more query. Aman THAKUR has emailed us his question. He writes into us saying, I'm a 27-year-old government employee, currently unmarried, and he already has his portfolio. It constitutes the Kotak Standard Multi-Cap, 5,000 put in that. SBI Small Cap and Mirae Asset Large Cap has 4,000 each. Then from the mid-cap space, there's L&T Mid-Cap Fund, where he invests around 5,000 per month. The MA Emerging Equities, I think we'll just check on which one that is. There's the Motilal Oswal Nasdaq 100 as well, where he puts in another 3,000 rupees. Plus, he also has around 3 lakh rupees, which he's expected to receive. He wants to know if he must invest in equity or buy in real estate. Okay, 3 lakh is, I think, too smaller amount, but I would assume that he already has some other money as well, and he wants to add that 3 lakh to that money to buy real estate. He already has a house and a vehicle, so that's something that's not his requirement currently. The real estate that he'll buy will probably be from an investment perspective. Okay, so yeah, Harsh, how would you, I mean, he's young, he's only 27 years, but he's built up a nice portfolio for himself, so he's kick-started his journey, so that's a good thing. But what do you make of the constituents of this fund? He purely wants this for wealth creation.
So, Mobina, you're right. At the age of 27, he's looked at his entire financial needs, and he's got investments into PF. His provident fund is about 20 lakhs right now, and the equity mutual funds, he's got large, mid, multi-cap. He's got an international fund in his portfolio. I think the construction of his portfolio is nice. I mean, there's no need to make any changes in his existing portfolio. Just from an existing portfolio observation, I mean, currently, as I said, he could continue investing in the schemes that he has, and there's no need to make any changes. Just there is one SBI small cap fund in his portfolio. Now, SBI small cap is also a very good scheme within the small cap category. Just that because it's a small cap fund, it's likely to be very volatile. The SBI small cap has about 48 to 50 companies in which they invest into. Now, in a small cap category, it's always better to split your money across as many number of companies as possible. So, in case this fund starts becoming very volatile or performs bad in the coming years, he could switch that amount into an HDFC small cap, because HDFC has about 70 companies in which they invest into. So from that perspective, the diversification is slightly more. However, just reiterating, the SBI small cap is a good fund. He can continue being invested in it. If in case in future it starts becoming volatile or underperforming, then he switches to an HDFC small cap. With regards to his 3 lakh rupees that he has as lump sum, of course, you rightly pointed out that with the 3 lakh rupees, he cannot buy into real estate. But since he's asked whether he should go for real estate or of equity fund, well, when you have a first house for your self-consumption and the second house is purely as investment, evaluate that investing into the property as a pure investment, which means that you will compare it on several grounds, such as liquidity, the taxability, the returns the potential that product has. The third would be, in case I need to manage, I need to buy it and I need to keep it with me, what is the recurring cost I will incur? So obviously, if you have a property, there's a lot of recurring expenses that you will have, and against investment in equity through a mutual fund or in a demat account, there is not much of expense that you will have. So when you evaluate on different investment parameters, it's a hands down answer that you need to definitely invest into financial products, and equity for that matter. If he's comfortable and he's got long-term view, then of course equity is an asset class. So debt for that matter, or rather real estate for that matter, can be avoided with this sum of money, and considering all the other parameters that I just spoke about.
Okay, well, there you have it. I hope this has been able to help you out. Thanks a lot then, Harsh, for joining us and patiently answering the plethora of viewer queries we've received on this edition of Ask the Money Show. Okay, folks, we'll take a very short break. When we return, we will be getting on board Sanjay Dongre of UTI Multi-Asset Fund. He manages that fund, and we will be talking about the fund in our Meet Your Fund Manager segment just when we return.